All right, there we go. Um, Tonight we're going to be talking about dissecting the fundamentals here. All right, and the the reason I listed as dissecting the fundamentals is because you know the fundamentals isn't just about the things we're going to talk about tonight. The fundamentals encompasses everything that we've looked at so far, and then it goes deeper into an understanding of the business. Right? Fundamentals involves understanding the competitive edge of the business, all these things, right? Like, but let me start with this really quickly here. Right? Imagine you own a company and the stock was to drop 30% in a single day. Now, imagine, imagine you have at that moment realized that you have no idea why you bought this company in the first place. Imagine you don't know what the company's up to, what they're doing. Right? Imagine you don't know what's important about the company and what's not. What kind of decisions can you really make besides speculative and emotional ones? Right? Without truly understanding the business, this is what we call guesswork. You're guessing. Um, when you do know everything that you need to know about a company, and we can also pin it down more to just everything that you could possibly know thus far. Um, then all of a sudden, dropping the company stock looks more like an opportunity. It looks more like you might be getting a discount. All right. Now, it could also be proving to you that your thesis that you originally came up with is no longer viable. Maybe this is the moment that your thesis was proven to be wrong. You can only know that if you had a thesis to begin with. You can only know that if you actually had knowledge of the company, enough knowledge that you were able to look at the reason the company is coming down and match that up against the things that you know and determine whether or not what's happening with the company in this present moment outweighs what you see for the company in the future. When we decide to invest in a company, we take it step by step. All right. Step one, as we discussed, filtering out the market. All right. Just getting all the companies you don't want to invest in out of the way. Get them out of the way now. Step two is picking the best candidates out of that final group, whether that be based on the sector or the industry that you want to invest in, whatever, right? Gets them picked out of that group. Um, Step three is running the numbers, the quantitative side. of this fundamental analysis. Then the next step, step 4, is what we're discussing tonight, which is dissecting the fundamentals. Now, your numbers, the numbers that you come up with, would have already made suggestions, so to speak. All right. The numbers would have suggested that the company's been improving or that the company's been in a decline. The numbers would have suggested that the company's trading at a discount or at a premium. The numbers would have suggested that the company has a competitive edge or that they're losing market share. Right? That they're growing or they're shrinking. That they have sufficient cash or that all their earnings really are is fancy accounting. Right? The numbers will make these suggestions. Dissecting the fundamentals will shine a light on those numbers and determine whether or not it's all fluff or it really is fundamentally sound. I have Intuit up on my screen right now. I'm going to leave it there. We're going to start with this company tonight. Let's be clear about this part here. I only get to a point where I want to know more about a company if they if the numbers that I see prove that I should want to know more. And yes, if you're in the room on Clubhouse right now, please note that I am showing everything that I'm talking about on my screen right now. You click the link at the top of the room and hit watch us on Twitch. Okay? Hit the link at the top of the room, click watch us on Twitch, and come check this out. Thank you, Anisha. Okay. So essentially in this stage, we use the knowledge we gain about the company to verify the numbers. All right. So let's do a little digging here. In fact, let me just refresh this, and I'm going to show you guys what this process looks like. Okay, so right now I'm using what's known as the Oracle X. This is a tool that I use to grab all the numbers for a company, and I also use this tool to take the particular stock that we're looking at and to pull in as much information as I can, like what's currently happening with the company, what are what are some of the red flags, so on and so forth, right? But now, this isn't going to be the be all end all of finding out about a company, but it's going to be a great start. This cuts hours off of our research time here. So let's start this over again. All right, so I'm going to type it into it. So what's going to happen is just going to give me all the numbers I need to know about Intuit. And then after it gives me the numbers, it's going to give me a quantitative thesis, right? And then we'll start to go from there, where it will also have it'll also have a news section, earnings section, and a red flag section. All right. This is the beginning of knowing things about the company. But let's first talk about what we know from the numbers. So, from the numbers, it says that Intuit has an F score of an 8. What that suggests, strictly looking at the numbers, is that Intuit as a company is improving year over year in 8 out of 9 categories. Right? Again, all numbers for now. We'll put it all together. Then we have a price to book of a 3.5. Well, 3.6. Let's round it up. Um, a price to book is essentially what am I paying for the net worth of the company, right? So, like, a net worth of an individual and a net worth of the company is the same thing. What you own versus what you owe. Okay. So if you own $100,000 in assets and you owe $50,000 in debt, then your net worth would be 50,000. Just putting it in a nutshell, right? We don't want to get fancy or play semantics here. We're just kind of keeping it simple here. Okay. What you own minus what you owe, net worth. The same thing works for a company. You take what they own versus what they owe, and you get the same thing. And then we ask, what are we paying for it? In the case of Intuit, we're paying 3.6 times their net worth for the company. Now, in a nutshell, like if without having any prior knowledge about the market, that may sound like it's very high. In fact, what we like to do is measure that against the rest of the sector that the company's in. They're in the tech sector. So we come down here and you can see right here, the average tech sector price to book is at 8.2. So 3.6 is actually not that bad at all, right? Now, let me be clear. You see these little numbers that are below, let me zoom in for you guys here. All right. You see these little numbers, all right? So you're either going to see a 1 or a 0 below those. I'm going to see either a 1 or a 0 below each one of these metrics here. That means that we have our system already checked this for us. All right. So I want to show you for price to book what that looks like. But from this point forward, we'll just, keep moving through and you'll know that, right? It's already been graded. It's already been scored. All right. Now, then we have our return. I'm sorry, before we move on to return on invested capital, our price to book here, right? When it comes down to our price to book, this is what we call a valuation metric or a valuation multiple. Okay. And we have 1, 2, 3 of these multiples in our quantitative system, in our system that just goes by the numbers. We have 3 of those here. So this is just one of 3. All right. Now, next, we have the return on invested capital. And this is proof that the company is taking whatever we invest in the company and turning it into more money. This means that they got a 20.6% return on the invested capital in this recent period. All right. So that's the debt that they picked up and the additional equity that we allowed them to pick up on our behalf as well. All right, which is really just the retained earnings, right? So the company makes some money, but they don't give it to you. They put it back in the company. Well, whatever they did with that money, did they generate a return on it? In this particular case, they generated a 21, let's just call it a 21% return. Let's round it up. Okay. You can see that little one there, so that means that they passed, right? That means that this is enough to beat the rest of their sector, or at least be better than the average company in their sector. This is what I like to look at as the sign of a competitive edge. All right. The F score, I look at that as a sign of an accelerating or a decelerating company. 8 out of 9 suggests they're accelerating. All right. For the return on invested capital, when they pass this grade, it says that they do in fact have a competitive edge. All right. Now, then we go to the price to free cash flow. All right. P/FCF right here. Price to free cash flow. Now, this is one of our other valuation multiples here. This particular one deals with what we call free cash flow yield. Keeping it very simple, for every dollar I spend on the company, well, how many dollars of cash am I getting? All right. So when you have a 9 here, this is like saying I'm spending $9 for $1 of cash. Again, that may sound like a lot. Over time, you start to realize that the numbers mean nothing when they stand by themselves. They only mean something when they're compared to something else, or when you have just this irrefutable, evidence that like a dollar for a dollar, for example, right? That's irrefutable evidence that I'm getting a deal, right? If you give me $1 of cash for $1 of my investment, that's going to be a really great deal. Well, you have to start asking why the deal is so good, but that's a story for another time, right? But in this particular case, $9, and they get a 1 here, so that means that pretty clearly this is a good enough deal that we don't have to worry about this being and I can let you know right now, anything below 40 in the tech sector is pretty decent. They're at a 9.2. The next two things here we have are the earnings growth and sales growth. I'm just going to put those together because that is essentially growth and profitability of the business. Right? Is the business growing and profitable? That's what we're asking ourselves right now. All right. And we can see that certainly sales are growing. That's the growth of the business, and earnings are growing, and so the business is becoming a little more profitable. Actually, that's a pretty decent number. 33% is pretty decent. So both of these are great. When we come around, so let's focus on this top row now for a second, then we'll go down to the bottom row there. We've got the last three elements there. When it boils down to it, when I start dissecting the fundamentals, right, as it relates to the F score, for example, what I will want to see is that this is not just a seasonal thing. That I'm dealing with a business who can continue to push these boundaries. When I look at the return on invested capital, I'm going to want to verify that competitive edge. Do they actually have a competitive edge? Okay. And I can verify that by being able to tell, you know, can their customers really operate without them? Can they switch to another competitor? Are there other people in the field that are threatening the business? Those types of things. All right. Um, and we'll talk all about that. All right. 1 second here. All right. Now, when it comes down to the earnings growth and the sales growth, I will want to know that I'm looking at a business that's likely to continue to generate sales and earnings growth. Right, that's what I'm going to want to know. That I am. I'm looking at a company that I feel like I can depend on for the future. Now, get this, right? This cash flow that I'm buying right here is going to help with that. Okay. So I can look at the history of the company's cash flows if I wanted to, and that could really help. Now, down here, price to earnings growth. Right now, this is suggesting that I'm only paying for 65% of the company's growth, meaning, according to this, I'm getting a discount, according to this. All right. Um, what what I find out about the company and the things that they're doing in order to try to achieve this growth will certainly it will certainly be something that I can look at down the line, right? To determine, am I looking at a multi-year, breakout for the company here, or are these growth numbers a little over exaggerated? These are your growth numbers here. 15% is the projected growth. We'll see if when we're done, we really feel like they're going to grow that much. All right. Um, the higher the growth rate expectations, I start to care a little bit less if the growth is discounted. The reason for that is because, the less and less realistic the growth expectations become, the harder it is to really gain any type of a thesis that I might actually be getting a discount on that growth. Okay. The quality of earnings. This is my free cash flow versus my this is my free cash flow versus my earnings. And um what it's really telling me is that the company has some money in the cash registers. Like, they're actually making the cash. They're not just putting IOUs in the cash register. They're putting real cash in the register, right? And then the debt to free cash flow tells me whether or not my cash can cover my debt over certain periods of time. In this particular case, the company could pay off all their debt in less than 1 year. So when this number is less than one, that means they can pay off all their debt in less than 1 year, just using the cash flow they got in the past year. Okay? Well, when this number is above one, let's say it was a three, then the free cash flow that they got in the past year, it would take three times that to pay off all their debt. Right? I usually look for anything um, five times that amount or less. Okay. Now, now we know the numbers. Now we know the numbers. And, well, there's one kind of a hidden figure here is relative strength, and that's, is the company outperforming the market or underperforming the market? When this number is above one, they're outperforming the market. And it's relative strength. But now we know the numbers. The question is, do we know the business? That's how it works. Now that we know the numbers, the question becomes, do we know the business? If the answer to that question is no, it's time to start digging, because what I will not do, what I cannot do, is say just because I know a bunch of numbers, it's okay for me to invest in a company. Trust me, that's not what you want to do. Okay. Um, what what we really want to do here is now read as much as we can about the business, and you don't have to go on for you know hours and days and days. What I tell the students that I have is this, right? I want to read as much about a company as it takes to um want to, or to be able to make a decision. But my learning process about a company doesn't stop after that decision is made. I still want to learn as much as I can about the company while I already own them. And so, for example, I built into the portfolio tracker that I gave everybody. Down here, we have all this material news and press releases here. All right. So let's see here. Is there anything for Intuit in here? Let's see. I'm not sure. Let's find out. So nothing material happening with Intuit right now. According to this, I'll run a little. I'll run another scan real quick, and we'll see. But let's come back over here though. So if you are just starting to learn about the business, right? Then voila, you got your first piece of information right here. All right, and it says, Intuit creates software that helps people and small businesses manage their money, taxes, and marketing. Now, what I learned about Intuit is that the marketing thing is just becoming a bigger part of their business. Okay. Um, and I like it. You know, they just bought a new SEO company that helps businesses with search engine optimization. Now, I will admit that in the age of AI, my one key concern is that search results will start to matter less. That's my one key concern. Okay. But either way you put it, I do believe that search optimization can still work in the age of AI, and I'm going to leave it up to Intuit to prove that to me. Prove it to me. I believe that search can still work. How do I believe it can still work? All right. I believe search optimization can still work because AI still draws their information from search results. Right. So now it's actually just a more refined search. For example, right? I could go to AI right now, and what you guys are learning a little thing that I like to call the guided alpha model. Right? You're learning the guided alpha model. So, what if I went to AI and I said, "What is the guided alpha model?" Now, here's the thing, right? Before I punch this in here, um, the the results that we get here, right? The results that we get here is going to be directly from knowledge base and from search. So the other beautiful part about it is that AI can store knowledge and then deliver information to you in that way as well. Check this out. What is the guided alpha model? Let's see. Let's see if okay, it says the guided alpha model is a proprietary financial framework. It says that you developed, right? Because it knows who I am, right? To facilitate systematic investment analysis, it functions as a core component of your broader four-pillar investment strategy, which integrates quantitative, fundamental, technical, and valuation metrics, so on and so forth. You see this, right? So AI can store a little information. Okay. Um, let's see here. Hmm. Let's come back over here. All right. Now, matter of fact, let's go to google.com. Let's go here, right? And let's type in let's do it like this. to that. What do they got here? No, so they have got alpha models, a psychological meditative framework. All right, let's see here. Let's put in investing here. Let's see what they do. Uh, huh. Let's see. So we're not quite popping up here yet. So we'll see how this plays out over the next couple of weeks, and we'll search over it again. All right. I just wanted to see what it would say on Google itself. All right. Now, so Intuit also helps with marketing. Right. Now, it says here that they operate by selling subscriptions for popular tools like TurboTax and QuickBooks, ensuring customers pay a regular fee to use their services. Now, this is going to be important. Do you believe that TurboTax and QuickBooks is something that still has a future or not? And don't overthink this, right? If I have no real idea about this particular industry, like the role of accounting and so on and so forth, right? Then it's going to be really hard for me to come up with that idea, right? It's going to be really hard for me to say that I believe that somehow, some way, QuickBooks and TurboTax are going to be gone in 5 years. So don't overthink this part. But if you have some inside insight, then you kind of already have the ability to think in the future here, right? Like let's say you work in accounting for a corporation, and you guys have been talking about getting rid of QuickBooks for some AI, software, something like that, right? And you could also look into those types of things as well, right? But one of the things I like to do is I like to look at the numbers, right? Plain and simple, flat out. Let's go to stockanalysis.com, and we're going to check how their subscription revenue has been working. How has it been coming in? It goes into it right there. Let's go to the metrics tab. All right. Let's see here. So, okay, you can see right here, all right, this particular part of their business for small business has been shrinking. Credit Karma, shrinking, and the Pro Connect growth, shrinking. But here's what's really interesting. The consumer part of their business is up 60%. Okay? What's the largest part of their business? The consumer side is the largest part. In fact, all in all, their business still grew from 6 billion in 2025 to 9.4 billion in 2026. So, from what I can see here, I think it's pretty clear that while their business is shrinking in other areas, it's being more than made up for in other areas. So it's an acceleration here, as opposed to here. All right. Now, what if I was to go to revenue by segment? Okay. So you can see here global business solutions. And so this is what usually happens right here. So what likely happened is they created a new category. You see that? They created a new category for their business, right? They created a new category for their business. And that is what actually led to what we saw as a drop off in small business. See how you gotta learn these things. Okay? And that's why the business is still growing like that, because when it's all said and done, you have you have actually done away with small business and self-employed and went over to global business solutions. Okay? So now what do I want to do? Now I say, okay, you know what? Let me find out about this global business solutions segment. Here's what I'm gonna do though. All right, let's grab this. All right, let's bring this over here. All right, we're just gonna run this through here. So we're noticing that Intuit switched, right? Intuit switched from seems to be seeing a decrease in, let's go with this, small business and self-employed revenue. Right. All right. But a an increase in what seems to be a new segment listed as, and you can see global business solutions, right? Global business solutions here. Where are we at here? Hold on one second. Uh, right? Global business solutions started right here in 2020, September 2025. Okay. Global business solutions. All right. What do I need to know here? Mm, what? Mm, mm, all right. That's a good enough question there, right? So I know the numbers, like I said, right? So there's this appearance of a competitive advantage and so on and so forth, and we got all these things going on. The company appears to have this revenue growth, but then now when I look at the numbers, I see a decline in a particular segment with a major pop in another. All right. So based on the chart into its recent financial reporting, the shift you're observing is not a decline in business performance, but rather a rebranding, right? As I pointed out, a reorganization of their segments. Okay. Um. So, and I've been through this so many times. That's how I was able to pick up on it so easily. So small business renamed global business in August 2024. Intuit officially renamed the small business self-employed group to the global business solutions, right? Um, somebody that doesn't know much would have said, look at all this declining revenue, right? No, it's just going into another segment. That's all it is. Okay. Um, so the visual drop in the pink bar and the corresponding rise in the medium blue bar. The chart reflects the reclassification of Intuit as Intuit moved revenue reporting from the old name to the new one. Okay, that's it. All right, so no loss of business. Intuit made the changes to better align their reporting with their AI driven expert platform strategy. Okay. Um, the global business segment is primary growth engine for the company. All right. Despite the label change, the underlying business operations, such as QuickBooks and the ecosystem connected financial services, have continued to grow. We just QuickBooks has continued to grow. Keywords. So in researching one element, we find some other elements there, right? Um, but while we're at it, all right. And this is what I usually like to do. Like, so you guys have not really seen me do this a lot. But this is what I usually like to do. What I do is, as I'm reading through the the data or the material on the business, I usually just come right over and just again, I dissect it. All right, we are dissecting the fundamentals piece by piece. Our goal is to find out, do we actually trust the numbers? That's your goal right now. Do you trust the numbers? Okay. Um, so the threats to Intuit's core products fall into two distinct categories: operational competition from industry peers and existential risks from shifting regulatory or technology landscapes. Competitive threats: Intuit faces pressure from specialized platforms that cater to specific market segments. All right, QuickBooks competitors, Zero and Sage Intact are the most prominent alternatives. The Zero focusing on scalability and user counts, and Sage targeting large multi-entry enterprises. Zoho Books and FreshBooks are often cited for their cost efficiency, yada, yada, yada. Newer entrants like Mercury and Ramp pose a different threat by bundling accounting features directly into banking and spend management suites. Well, what we know about Intuit is that they've been doing some bundling as well. They give an entire HR suite. So, I mean, bundle away, right? For these companies, the accounting ledger is a feature rather than a standalone product, allowing them to underprice traditional software like QuickBooks. Understood. Um, so they got some pricing wars going on here. The number one thing when you have a company like Intuit, do they have the margins? Do they have the margins to sacrifice? See, I'm hearing a lot of smaller companies, right? I'm hearing of a lot of smaller companies. But do those smaller companies have the real ability to put pressure on Intuit, or will Intuit only be able to price them out of the market anyway? Uh, you know, that becomes the question, right? Because Intuit maybe they don't have to match their prices, but they can lower the cost of their product enough to where it becomes a bargain, right? and it still makes those other guys look a little bit less realistic. Is there any real danger? Let's get straight to the nitty gritty here. All right. There's a stark disconnect between market sentiment and operating reality. Right. Intuit's stock price has experienced a significant decline, dropping 67% from its 52-week high. This sell-off is widely attributed by analysts to an AI disruption narrative where the market fears the foundational AI models or fintech bundlers will eventually erode into its moat. Now, despite the stock price decline, Intuit's core business remains robust. As of May 2026 earnings call, Intuit reported 10% year-over-year revenue growth. The company maintains high EBITDA margins. This is what I was talking about right here, 55%, outperforming peers like ADP and Workday. Okay, so that's what I was talking about. So their margins are doing better. All right. Structural pivot. The company is successfully transitioning to live services. TurboTax customer growth reached 38% in the third quarter of 2026, and it now represents over 50% of total TurboTax revenues, signaling that the company is effectively shifting users from DIY software to higher value service-based offerings. So people actually are enjoying just getting on live with a real tax professional. I've seen some of that when I was doing the original research, and yeah, it looks really good. Just to have that person just pop up on your screen and say, "Hey, what's good? I'm here to help you with your taxes," right? And voila, like that's priceless. So I don't think you could charge. I don't think these other companies could charge the same amount for that service as you know. Are they as trusted as TurboTax? Do they have the technology as well? Right. Okay. So we dissected some of that stuff there. Let me just pause right here, right now. All right. Has anything you guys have heard so far? All right, this goes for everybody that's in the room. Whether you're in the audience, you're just listening on the Twitch, whatever it is, right? Has anything you've heard so far led you to doubt the numbers? Anything so far, yes or no? Right? Is what you are hearing confirming the numbers or questioning the numbers? That's the question. Y'all put in the chat. Confirming the numbers or questioning the numbers? What's this information leading you to do? All right, Anisha says confirming. Alicia says confirming. Cecily says confirming. All right. Christopher says confirming. Okay. So Prince says confirming. All right. That's how this works, guys. Okay. I'm running you through the process here. So again, let's dial it down. We filtered the market. We filtered through the market. Right. We filtered through the market. We pick the best candidates out of that filter. We run the numbers on those companies, right? And then we dissect the fundamentals to find out, are we going to confirm what we're seeing here, or are we going to just get more questions? If what you're doing and what you're learning about the business is just leading to more and more questions, I would argue, you might be about to spend a whole lot of time on a company where the end result is you still don't know what you want to do, right? For me, the ideal outcome for me, what's up, Burn Rich? Um, Why the margins are better than ADP and Workday? What's going on? What's going on? Justin says confirming as well. I'm coming back around to that question as well, Burn Rich. I'm gonna come back to that question. That's a great question, right? Um, but it usually just boils right down to efficiency and technology in a space like this, right? Those companies probably just don't have the same ability to charge the premium price, right? But we are going to look into that. But as I was saying here, guys, like you want to you want to make sure that well, let me say it like this, right? What I like to do is I like to like start digging into the company and get to the point of confirming the numbers or like confirming the fundamentals behind the numbers. And I want to, within a short period of time, I want to be immediately affirmed that the numbers that I'm looking at are really like they are the real deal before I spend too much time on a company, because I want to spend most of my time learning about the company as somebody that owns it. That's just me. You don't have to do the same thing. You can search to your heart's desire. Um, you can spend hours, days, weeks researching companies. You don't have to be like me. Okay? That part is up to you. I said what I like to do. Right? I like to spend most of my time learning about a company as somebody that owns it. What I want to know right out the gate are the things that confirm these numbers. Right? Because and the reason let me explain to you why that is for me. Because what I have here in front of me, these numbers that I have here in front of me, right? These numbers are proven to have predictive capabilities of stock performance. Okay? Um, Companies with high F scores, high return on invested capital, tend to perform really well. Um, so you can see the type of research I'm doing. So I'm clearly doing extensive research. This isn't light research, right? It just doesn't take me a lot of time to understand what I'm looking at. And the longer it takes me to try to understand what I'm looking at, the more I know this is not the company for me, right? If I'm like, I just read like, I don't know, I just read 50,000 words and I still have no idea what's going on. Yeah, like I'm thinking there's probably a company out there that's easier for me to understand, right? Does everybody understand it? Does that make sense to you guys? I mean, again, you can do whatever you please. I'm just wondering, you let me know if I'm crazy, right? But if I read the equivalent of 3 essays and I still have no idea, like I still have no real understanding of this company, and I can't even confirm these numbers in front of me. Yeah, I would argue that I can probably get a better understanding of another company a lot faster. Right? It's like if I was reading about Walmart, right? It won't take that long to understand Walmart. It may take a little bit longer to understand some semiconductor company, right? And there are some semiconductor companies out there that I really don't understand as much as others. Where I'm like, I can't even invest in these guys because I have no idea what they're talking about. Whereas another semiconductor company, I get it. They're built on infrastructure, and you know, they're really their goal is really to be the stack behind um, all models and all kinds of different. I'm speaking of Nvidia in this particular case, right? But yeah, it's like even if I can understand where their money comes from, right? That kind of stuff as well, right? Um, and give me 1 second, I gotta write something down real quick. All right, let's read a little bit more here, right? And then we'll start to like dial it down and rein it in a little bit here, right? Um, we go on to learn here, right? Such that the stock price could increase if the company continues to grow in newer divisions like Credit Karma, or if more small businesses upgrade to their premium software packages. Is what I was talking about there. Right. On the other hand, price could decrease if new laws simplify the tax process enough that people no longer feel the need to pay for professional filing help. Right? Given a strong financial health and a price that looks cheap compared to its expected growth, the company currently represents a high quality investment opportunity. Now, I just want to say this right now, right? Because so as I'm reading this, do I believe that there could come a point where people no longer need to pay tax professionals? Yes. I do believe that time could come. Now, a part of my thesis would be that I don't think that time's going to come right now. I don't even think that time's going to come in the next 5 to 10 years. Now, guess what? This is exactly where my thesis could be proven wrong. Tomorrow, tomorrow, my entire investment could be blown up, right? As we come to find out that brewing beneath the surface was some major breakthrough in innovation, or some law that comes out like they said that all of a sudden tax filings are done this way or this way, and then TurboTax is obsolete overnight, like that. Stock drops 50%. I'm done. I'm toast. Okay. Yes, that can certainly happen. Certainly it can happen. But that I believe it would take a long time to transition into that. And so for now, I feel safe in this investment, and we'll see how it plays out. Okay. And I happen to believe that they may figure out this AI thing for tax purposes, being able to maybe upload your tax filings and have most of the work done um, you know, by AI or something like that. I don't know. I don't know how they're gonna end up doing it. All right. Now from here, I can launch my news groundings, my red flags, all that good stuff. In the meantime, right? We said why is all right. Here we go. All right, you with me? You with me, Burn Rich? Here we go. We're finding out right now. Let's find out. Trends with significantly higher profit margins, boasting EBITDA margins of 55% as of 2026 compared to ADP and Workday are structural, driven by fundamental differences in business model, scalability, and service delivery, while ADP and Workday are tethered to labor-intensive service or high-touch enterprise models. Intuit has successfully transitioned to a high-margin AI-driven expert platform. Right, the primary driver into its margin advantage is the inherent scalability of its software compared to the operational intensity of its competitors. Like I said, you know, this is where the technology plays a role, right? They operate a software first ecosystem, right? Whereas ADP's model is built on compliance, payroll, processing, and HR outsourcing. Workday competes in the high-end enterprise space where the cost of doing business is significantly higher. Their model involves long, bespoke sales cycles, complex 6 to 18 month implementations, and so on and so forth. You get the point, right? So, in a nutshell, man, you know, um, Intuit is just more hands-on, less hands-on, more tech, more software. That is that is essentially what makes them more more marginally profitable than their competitors there. All right. All right, here we go. So let's see what's been going on. So they reported third quarter revenue $8.6 billion, highlighted by 30% increase in sales for high-end tax health. Okay. To accelerate their shift toward modern technology, the company is officially ending support for older desktop accounting tools and moving users to a cloud system that uses generative AI to handle routine bookkeeping. Would you look at that? All right. The firm also recently reduced its total staff by 17% to lower its long-term expenses and focus its budget on hiring specialized engineers. Give me 1 second, guys. I'm back. Yeah, Burn Rich, I've been doing this a while, so I like kind of like have like a little bit of sometimes, not all the time, but sometimes when I see something, I can kind of draw back to uh either memory or prior knowledge of something, and I can use that to help understand this new thing that's in front of me. Um, this is just one of those things where usually technology ends up being the reason why two competitors, you know, um, have different margins. And if it's not technology, then it's usually going to be vertical integration, right? Where this one company was able to like handle more of whatever they're doing in house. And a lot of times, what I saw a lot of times was then that company ends up becoming a supplier to their competitor. Now they're earning some of their competitors' money. Seen a lot of that sometimes as well, and I love when that happens. That's one of my favorite things to see. All right, so they also recently reduced total staff by 17%. We saw that strategy replacing human-led Services with automated intelligence allows the company to grow its profits quickly, but creates a significant danger if the technology makes error. I was just thinking that too. Like, I wonder how they're handling that. Like, is there some like of agreement if there's a mistake, right? That they have to do they have to divvy up? Are they the ones that have to pay off that? What needs to happen there? Because I would assume that they're smart enough to say, "Hey, listen, you know, our system does the work, right? Data injury, all those things, right? And then delivers it for confirmation." You know, I would assume that that's probably for the best, but I guess we'll have to see how that plays out. But I mean, if we are dealing with QuickBooks, the beautiful thing about that is it's a low margin for error, and I'll explain why. Let me explain to you guys why. Right? The reason why dealing with like something like QuickBooks is a low margin for error is because we have the actual numbers in front of us. So it's going to be very difficult for a computer to get 1 + 1 is 2 wrong, you know, um, from that particular perspective. So if I'm inputting the actual numbers, right, and then I can train it to understand my business if I need any nuances. But if it's mainly, you see what it says here, right? Where is it at here? Where was it at? Right? To handle routine bookkeeping. Those are the key words, right? So if it would have said like, oh, it's handling all the company's corporate taxes or something like that, then I'd be like, you know, not so routine, But routine bookkeeping, like just making sure, hey, you know what? Like I'll give you guys an example, right? Have you guys ever heard of what was the name of these? This man, I wish I could remember the name of this card, but basically it was this card from American Express that I used to use for my business, right? And it handled a lot of routine bookkeeping as well, like So basically, um, after I make a purchase, after I make a purchase, it could then um, it could then say, okay, well, first things first. Um, After I swipe the card, I can go into the app and say that was business supplies, right? I swipe the card again. That was let's say it was a personal meal, it was whatever, right? Swipe the card again. That was subscription for my business and that kind of stuff, right? So I basically file things under personal and business expenses, right? So now if I go back to the same store I bought the business supplies from and I swipe that card, it's going to automatically file it under business supplies. Wonderful stuff, right? My taxes, I go and I print this stuff out at the end of the year. I take it to my tax preparator and I'm like, business, personal, here you go, right? Everything is there, every receipt, everything that ever happened. Um, and the beautiful part is I could have my client have another card on their end. And so if they needed to send money for a marketing campaign or anything like that, they could send the money directly to that American Express card, just like that, just a transfer, quick transfer between the two accounts, right? And it was an um, amazing way to handle business in that way. So that's how I look at this. Is when I think about routine bookkeeping, that's what I think about routine bookkeeping. That's what I think about. That's not that hard to do. So I'm not concerned about the potential errors. The margin for error is very low, right? I mean, what are the odds they go shopping at Home Depot and the card says, "Oh, yeah, he went shopping at Sally Beauty." I doubt that's going to happen, right? So, um, let's see here. Intuit is achieving the impossible by firing thousands of workers, even as its profits reach record-breaking levels. The company operates by selling online subscriptions for tools, TurboTax, blah blah blah. We know that. They're no longer a simple software seller, but an essential gatekeeper that thrives by turning the confusing rules of government taxes into a paid service. A timeless rule of investing is that when a company makes it difficult and painful for customers to switch to a competitor, it gains the power to raise prices whenever it wants. Also, something that we talked about earlier, right? That they would have pricing power as well. And here it is. Because can you do what I do as well as I do? Right? If not, I have the power to charge whatever I want. Right? So it stands on Intuit stands on a bedrock of cash. Intuit stands on a bedrock of cash that sorry about that, I had to grab something there. That makes it one of the most stable companies in the software industry according to the fundamental numbers. Right? See the fundamental numbers, right? Uh the safety of the balance sheet is defined by the fact that the company generates a massive amount of cash compared to its market price and its total debt. Right? With a Savannah, can you get down, please? Um, there's a return on invested capital of above 20%. The business is proving that it uses its money efficiently to generate high profits without overextending itself. This specific combination of high efficiency and low debt relative to cash flow suggests a fortress like financial position with little room for sudden collapse, right? So, I mean, I'm just going to pause there really quickly. Let's just pause there really quickly because, you know, I, at these stages, I begin to realize I've heard enough, right? I begin to realize I've heard enough. We have a company with a competitive advantage. Um, the numbers suggested a competitive edge. Um, everything that we're learning about the business proves that competitive edge that we see in the numbers is actually there in the business. The expansion that the F score suggests that we should see, we are seeing, right? Um, so the numbers here are being confirmed, and so the reality is this: the company is currently underperforming the market. Let's just boil this down. The company is currently underperforming the market. Okay? They're not doing too well performance wise, the stock, as far as the stock is concerned. So now, what I'm seeing here is it is suggesting to me that I would not mind taking a chance on this business. It's suggesting to me that in a time like where we are right now, where I believe that there's not a lot of margin of safety out there that exists, that I would be okay. Um, that I would be okay buying into it and you know seeing where we go from here. I do believe that there's a high possibility that um, you know 5 years from now I'll be sitting on a profit in this business. That's how I look at it. Um, remember what I said to you guys recently, right? Um, it goes from concerns about the short term to certainty about the long term, right? What I'm seeing right now doesn't give me much concern about the short term. Okay. Um, I feel like I feel like I have a margin of safety here in the short term that can, buffer things a bit. And you know what? If if this company is about to go out of business, then nothing I'm seeing here today could have told me that. Nothing. Everything I see here today is telling me that if I invest in this company 5 years from now, I should be able to look back and say, I am very happy I bought them at $70 billion valuation. Right? Um, okay. So quick notes here. Does anybody have any questions, any comments? How do you feel about how the numbers matched up with what you learned about Intuit? Whatever it is you got to say, whatever it is you got to, work with here. Talk to me. Oh, Savannah, get down, please. Get off my arm, thank you.
Just I like the step-by-step process that you went over once again. Just for some of us as a reminder, for other of us, it was probably new as far as the step-by-step process. Um, the way you started with the Oracle ads, all of that. I agree. If it doesn't, if I go to the Oracle ads, then it's not adding up. Then I don't like wasting my time. I like to go on to something else. Yeah. Uh, Yeah, I think it was very important, like going through your companies and getting to know the business and what they sell, and just making sure you do your, you know, due diligence, your research, so then you get more familiar with the company that you're looking to potentially purchase or be part owner with.
Yeah, definitely. And like I said, and for me, I continue that the entire time. So as long as I own the company, I'm just gonna keep learning more and more and more about them until I get to the point where, imagine if I can know Intuit as well as I know Apple, right? I would like that, you know, or as well as I know Microsoft, right? Like, those would be some really good, that'd be a really good, knowledge base to be drawn, to be able to draw off of. And I don't know if that's ever going to happen, but the reality is, you know, um, I know and I understand the business enough to be somebody that owns it. Um, I know that, initially they really just were, known as the tax and TurboTax and QuickBooks people, and then they slowly but surely work their way into like credit, and work their way into like business marketing. And I like the company that they acquired to get deeper into marketing, in SEO, SEM Rush. That was a really great investment in my eyes. So that's the other thing as well. So like you're going to end up digging in and finding out that the company's making acquisitions, right? Let me show you where you can do that. Go to stock analysis. Go to this main page right here, overview. Right, and you see all the new things that's happening here, right? You see they got downgraded on growth concerns right here. All right, you can start to go through these things here. There's a downgrade from Stifle, but look at this, right? They downgraded them to $275 per share is their target, right? So that's right above where they are right now, but it still leaves a little bit of a room, you know. But yeah, like you can find out a lot of things here. So like some other things that I like to look for are mergers and acquisitions. Right? Has the company recently bought another business or planning on buying another business or merging with another business? Those to me are signs of growth. Is the company hiring or firing people? If they're hiring people, then that's also a sign of growth. If they're firing people, that's a sign that they're trying to, either sustain growth or trying to get back to growth, right? So, in Intuit's case, they're trying to sustain growth. We can see that, right? And also I like to look for awards as well, So like my research wouldn't really stop here. I would dig a little bit deeper, and I'm looking for those types of things, like uh, believe it or not, there's a certain award. It's called the Best Places to Work. Believe it or not, those companies are actually known to outperform the market, right? So I like to find companies that are on the Best Places to Work list as well. Um, and I, all of my companies are not on that list. Okay, so don't think I'm saying every company has to be on that list, but when I can find them, I will certainly um when I can find them, I'll certainly dig deeper into those companies for sure. And you can even look for the best places to work list for the previous year if you wanted to. I do that sometimes. Again, that's a part of filtering the market, right? That's a filter. If I say best places to work 2025, that's a filter. Like I said, you start with a filter. Knowing what you want to invest in, that's a filter. Okay? Um, like if I say partner of the year award winner, and just type that in, I like to invest in partners of the year as well. Says to me that their customers are going to be with them for a long time, right? You don't just win partner of the year this year and then next year your customers start leaving you, right? I mean, that would be odd. But that would suggest more for the economy than it suggests for the company. Because I would think that the economy is starting to shift, and that's why. Either way, um, if nobody has any questions, I'm gonna.
I did want to add
Yeah,
that there's AI because it makes it a little more funner to do your research and put together like a Google sheet, and it also gives me the like what I should be looking like listening for at the next earnings call. But I'm gonna have AI listen, and then I make sure I feed it that this is what we should be listening for when we listen to this next earnings call. So I'm very excited about that. I already have tried it out with other things and letting it listen, and then be able to play back stuff too, like when you're on the move or whatnot. It just helps make it a little more funner because sometimes it could be at first for me. I could just speak at first. It's like pulling all of this stuff in manually. It can be a little like I'm kind of bored. But when you pull it together with AI and then you say, okay, I want the most high level information, or you're training it to tell you different things, it just makes it a little more funner.
yeah, yeah, definitely, definitely, definitely. Um, you want to be able to enjoy what you do 100%. And so any way you can, figure out to make this process, a little more exciting for you. I definitely support it. Just make sure that you're verifying, all the information that you're getting as well. So you still want to have your 10Ks on deck. You still want to have those things on deck, and
Oh, absolutely.
yeah,
That's absolutely important. And then I want the call transcripts. So yeah, I got nice process. And it's kind of like I'm getting into a rhythm, which is making it more funner too. And then as you're looking at like a group of like the industry, and then you're getting to know about that, like semiconductors or these communication equipment and all of this different stuff. It's just like I don't know. For women, it's like I can only speak for myself. I'm like this stuff is boring. I don't want to know. I don't care. Just give me some profit. But now it's like no. If you're going to be part owner, you need to understand where you're putting your capital and why you're putting your capital. Is it just me? Or is Anisha in the Matrix? Oh, am I in the Matrix?
no, no, it's just her.
Oh,
Yeah, Alicia, that's you, Alicia.
so what makes it funner too? I mean, I'm OMP, and it just makes it more funner. And then those words that you don't know, how you can just continue to probe AI to say, okay, when he said this, what was he talking about, or what was the high level, information. So it just makes it more funner.
Definitely, definitely, definitely. Anybody else though want to add something before we close out?
I just Googled the top places, best, what did you tell us?
Best places to work.
Yeah, of them are in the index. It just ran out the Fortune 100 companies. Yeah.
Yeah, like I always look for those if I can find them. So like, and this is where I usually find it right here on this first page of stock analysis. So like, 'cause those awards are given out like yearly, right? So I'll just kind of like scroll through and see if I can find it. Right. I'll just scroll through and see if I can find it. And if not, then I'm cool. Oh yeah, and I forgot they own Mailchimp now as well. Intuit does. I forgot about that. But yeah, so if I can find it, I'll find it. But it's either going to be that or it's going to be mergers and acquisitions, and and I'll just kind of let those things play out. From there. Like mergers take usually a year to play out. Acquisitions take usually a year to play out. Those types of things. So I had like that whole first year to just sit back and just see if it works or not, right? Tapestry didn't the merger didn't work out, the acquisition didn't work out, right? But we still made our money anyway, right? Um, and then some, right? So it's these little call signs you can tell, about like, future growth, future opportunities, and so like I said, so mergers, acquisitions, best places to work, and partner of the year. Right, those are some things I look for, like on my own. Like I don't really, um, I don't really expect it to pop up all the time in some of those like news feeds that I aggregate. So I'll have to come over to stock analysis and make sure, just double check for myself. So all right. Um, So, I mean, let this be something that you guys can practice, work through. If you wanted to check out a copy of this Oracle X thing that you see me guys using here, at the top of the room on Clubhouse, you see a link there that says at D1 Finance. Click on that, you'll see it says Oracle X stock analysis tool. All right. You can get it there if you wanted to. But other than that, guys, I will catch up with y'all later. Everybody be blessed, stay well, and I will talk to y'all soon. Later.
Thank you. Later.